Good day, friends. In the subject of fundamental of investment, today I'll be talking about approaches to security valuation. There are different approaches, there are different ways by which we value the security. Broadly speaking, there are three approaches: fundamental approach, that is we call it fundamental analysis, technical analysis, and efficient market hypothesis. In today's lecture, my focus will be on fundamental analysis. That while fundamental analysts, how they value the share, what is the right price of the share, this is the subject matter of the fundamental analysis. If I speak in one word, I would say intrinsic value of the share. Because when I am talking of the valuation of financial security, my focus will be here in this lecture, will be on the stocks, that is shares. So what the price should be as per the fundamental analyst, what is the right price of the share? This is the subject of discussion. I mean, when we talk of the intrinsic value, it means true worth of the share. When the market shows a particular price, sometime we call it overpriced, sometime we call it underpriced, sometime we call it fair priced. It depends on the approach which you are adopting and by which you are saying that whether the price is overpriced or whether the price is underpriced. As I said, that fundamental analysis, the intrinsic value is based on the expected cash inflow from the share. When I am talking what is the intrinsic value, what is the true value, as per the fundamental analyst, and the whole theory of this security valuation is based on discounting the future cash flow. That is, when you buy a share, how much cash inflows that will be generated by investment in that share for a infinite period of time. If you discount this, then we call it that this is the right price of the share. So fundamental analysis tries to find out the intrinsic value. As far as the technical analyst is concerned, technical analyst studies the charts, studies the trends, and they presume it. The premises is that history repeats itself. That by studying the historical data, historical prices of the share, they predict about the future price. And the third approach is efficient market hypothesis. Efficient market hypothesis, as per the efficient market hypothesis, basically we say the market is always correct. Market reflects the true price of the share. That share prices at all times to reflect the true value based on all available information. That is, whatever the information that is available with the people, with the people in general, on the basis of that information, the market reflects the true price of the share, the right price of the share. And it depends on the efficiency of the market, whether the market is highly efficient, whether the market is less than highly efficient, the speed with which it discounts the different informations. Suppose a company declares a dividend, and a company declares a dividend, immediately the moment it declares the dividend, immediately this information, whether the market perceives it in a good manner or in a not that much good manner, what is good manner, what is not that much good manner, means if the dividend declared by the company is more than the market expectations, certainly, I mean, it means it's a good news for the market, and immediately that will be reflected in the share price. If the dividend declared is less than the market expectation, it means it is a negative news, and the market price will reflect in the share price. What it means is that efficient market hypothesis presumes that market is always correct. It is the correct price that is being reflected in the market, and what is the correct price, how much is the correct price, and to how quickly the market discounts the news that is being reflected in a stock price. It depends on the efficiency of market. Anyway, in today's discussion, I'm not focusing on technical analysis and efficient market hypothesis. I'm basically focusing on the fundamental analysis. So fundamental analysis is the method used in determining the value of a stock by analyzing the financial data that is fundamental to the company. There are a whole host of information in the complete lecture of today's. We'll be talking of the different information, different financial information, different parameters, different factors that affects the fundamental value of a share. And basically, I will say the financial data, the data that affects the financial, like say, if I say in a layman terms, I will say the balance sheet, the income statement, and how the different parameters will affect the balance sheet, how the different parameters will be affecting the income statement of the company, and on the basis of that, the fundamental analyst value a share. So fundamental analysis is a stock valuation method that uses the financial and economic analysis, I am adding the word economic analysis, to predict the movement of the stock prices. Fundamental analysis typically focuses on key statistics in a company's financial statement to determine if the stock price is correctly valued. Right? Means that different statistical facts, the informations that affects the share price that is being reflected in the fundamental analysis. Fundamental analysis is a business involved analyzing its financial statement and health, its management and competitive advantages, its competitors and markets. When applied to future and forex, it focuses on the overall state of the economy, interest, production, earning and management. So these are the factors that are being included in the fundamental analysis, whether it is the corporate governance of the college, whether it is the corporate governance of the company, whether it is the competitive advantage of the company. Suppose there is a company which has a competitive advantage, there is no close competition. Certainly that company will able to fetch higher price in the market, means it will able to charge good price in the market, and obviously it will have an impact on the income statement of the company and balance sheet of the company, and that company will enjoy a higher pricing because that company has a pricing power in the sense because the company can charge good prices for its product. Suppose there is stiff competition in the market, it doesn't have any competitive advantage. So if there is a very stiff competition, no competitive advantage, in that case the pricing that will be charged by the company, the price of its product that will be charged by the company will be very, very competitive. It will not have a good profit margin, and that will be reflected in the income statement and the balance sheet. So certainly this company will not able to fetch very high stock prices. So depending on the corporate governance, depending on the financial statement, health of the company, financial, when I am saying health means how strong the balance sheet of the company is. If the company's balance sheet is strong, means it has good cash flows, it has good assets, it has healthy cash flow and the assets position. Certainly these companies enjoy higher price in the stock market. Price means I am saying in terms of the stock prices. So to conduct a company's stock valuation and predict its probable price evolution, this is what the fundamental analysts do. So to make a projection on its business performance, to evaluate its management, and to make internal decision to calculate the credit risk. So when I will be talking the different points in detail, all these things will be covered, right? So the process of fundamental analysis involves examining the economic, financial and other qualitative as well as quantitative factors related to a security so as to determine its intrinsic value with specific business irrespective of the industry or region. Suppose a company is industry is doing very well, say for example sugar industry, but there may be a company in the sugar industry which may not be doing very well because of the various factors, because its financial position is weak, its income profitability is not high, but there may be corporate governance issues. There are various qualitative and quantitative factors that can affect the company. So in the fundamental analysis, when I am talking of the company, basically we are focusing on the company's specific information. Now comes the very important thing, that there are two approaches in the fundamental analysis. One is called top-down approach, other is called the bottom-up approach. In the top-down approach, we start with economic analysis. That is economy, industry and company. First we study, first we see the overall health of the economy. And by seeing the overall health of the economy, we then come to the industry analysis. The company is in a particular industry. Industry is a group of companies engaged in the same business, right? Similar type of business. So then we come to the industry analysis, and then finally we come to the company analysis. With the presumption that if the economy is doing very well, then obviously, there is a great likelihood that industry and the company will also do well. So in the top-down approach, we start with the economy, and then industry, and then finally company analysis is being done. In the bottom-up approach, just the reverse is being done. It is a company-specific information, company-specific study. First we start with the company, then we go to the industry, and then we come to the economy, the overall scenario. So there are two different approaches of studying the fundamental analysis. One is called top-down, where we start with the economy, then industry, then company. The other is the bottom approach, starting with the company, then study the industry, then we talk of the economy. I'll be discussing these things in length. Now, when we are talking of economy, industry and company analysis, let me take one by one all the factors that affects, means very detailed discussion we'll have on the different factors which affect economy, which affects industry, which affects the company. Let me start with the economy. And when I'm talking of the economy, I'll not talk of the country-specific economy, but I'll start with the global scenario, right? Because whatever the global scenario is, that also affects the particular economy. If I talk of India, whatever is happening in the world, we say these days, the whole world is a village. So when the whole world is a village, so whatever is happening in the world, that also affects our Indian economy. That also makes an impact on the Indian economy. So when we are talking of economy, basically we have in our mind the particular country's economic conditions, economic positions. But since there are various factors, various international factors which also affects the economy, so while talking of the economic analysis, we'll also talk of the international factors. So economic analysis is the analysis of various macroeconomic factors that have a significant bearing on the value of various securities. Means since we are studying the top-down approach, we are talking of the whole economic scenario in the country, or I'll say not only the country, but in the world as a whole. So when the level of economic activity is low, means economy is not booming, there is a slow growth rate of the economy, obviously security prices are low. Means in such a scenario, I'm generalizing, I'm not talking of company specific things, I'm saying in general, when the economic condition of the country is not very good, in that scenario, there is a great likelihood then the stock prices of different securities will also be low, and vice versa. If whole of the economy is booming, there is a high rate of economic growth, right? Economy is booming, all the economic conditions are favorable. In such a scenario, obviously the stock prices also reflects a better picture. Means the stock prices are also showing the rise in the prices, the stock price also goes up. So what it means is, then when economic condition of a country is not that good, in that scenario, the share price will also be low. But if economic scenario is good, economy is booming, then at such a scenario, the share price also goes up. An analysis of the macroeconomic environment is essential to understand the behavior of the stock prices. I've already said. So there are various macroeconomic factors influencing the prices. So what are these macroeconomic factors? This is the subject of discussion. So global growth. I said every economy is being affected by whatever is happening internationally. If suppose there is a war between Russia and Ukraine, so because of the war between Russia and Ukraine, the oil prices have gone up, because Russia and Ukraine, Rus and Ukraine are the two major suppliers of crude oil in the world, right? So if the war is taking place, we are not getting enough supply, the world is not getting enough supply, so crude prices goes up, the other commodity prices goes up. In such a scenario, when the prices goes up, there is an inflation in the economy, it is going to affect negatively to the world economy. So no country will remain unaffected by it. So whatever is the overall global growth scenario in the world as a whole, right? So if recession takes place in America, America being the major economy of the world, right? So if in a major economy, America, China, the other two major economies of the world, if there is a recession, if there is a less growth rate in those countries, certainly it is going to affect the other countries also. We are very generalizing, but generally what happens? Because if there is an economic slowdown in China, obviously it is going to affect the other countries. I'm not saying all the countries will be affected to the same extent, but it will have repercussion on other countries also, because say for example, if China is also an exporter of various things, China is also an importer of various things, America is also an exporter of various things and importer of various things. So if there is a slowdown in America, certainly the exports of various countries will affect it. If there is a slow growth of export, it is going to affect the income level of a particular country, right? So the economic growth will be affected. Suppose there is a strong lockdown in China because of the COVID. So because of this lockdown, the demand is less of various commodities. So if the demand is less, the prices will come down, or the world as a whole, or the various countries which are importing raw material from China, they will not able to get raw material. And if the raw material is in scarce, certainly it is going to affect the different companies, different industry, and the production slowdown will take place. What it means is that whatever the global scenario of the world is, I mean to say the economic growth rate, right? So that will also affect the economy. So what is the global growth? That also affects the economy. One important. Political risk. There are various geopolitical risks that are involved. I just talked about the war situation between Russia and Ukraine. If the war is taking place, certainly there is the geopolitical risk increases. So when geopolitical risk increases, heavy investment do not take place at such time. Suppose there is a war within the country or war between the two countries. So it means there is a political instability. What is happening in Sri Lanka 2 days back, right? So if there is such a scenario, when there is an internal warlike situation in the country, certainly the political risk increases, right? So at that scenario, the industry doesn't grow. The companies do not grow at a fast rate because of the political risk involved. So international political environment where situation like war, border tension, terrorist attack, etc. can increase the volatility in the security market. So political risk, if the political risk is high, if the risk level is high, certainly it is not a very good scenario for the stock market. The stock prices is being reflected in the political risk. When political risk increases, the stock prices comes down. Well, political stability is there in the country, the risk level is less, certainly it is a good scenario for the stock prices, and the stock prices goes up. Exchange rate. See, no country works in isolation. Every country makes exports and import. So what is the scenario of what is the value of your currency vis-a-vis the international currency? Say for example, dollar. Dollar is considered to be, American dollar is being considered as a major currency of the world. So how dollar behaves? When I'm saying how dollar behaves, it means the value of the dollar vis-a-vis the value of the other currency. That also affects the stock market. So exchange rate of a country's currency with foreign currency has the potential to change the economic environment. A strengthening of a foreign currency depreciates the value of domestic currency, which affects export and import. Suppose the dollar prices are going up. When the dollar prices are going up vis-a-vis Indian rupee, so it means our export, means the value of the Indian currency is coming down. If the dollar appreciates vis-a-vis the Indian rupee, it means dollar is strengthening and Indian rupee is becoming weak. And some months back, 2-3 months back, 4 months back, the dollar was 72, 73 rupees. $1 is equal to 72 to 73 rupees. Today it is around 77 rupees, 76, 77 rupees. So it means $1 is equal to 76 or say 77 rupees. So if I take 77, it means, and as compared to the 4 months back or 6 months back when it was 72 rupees, it means rupee is weakening and dollar is strengthening. When rupee weakens, the value of a currency depreciate. In such a scenario, export get positive impact, because for by and large exports we get income in terms of dollars, right? But import is being negatively affected. In such a scenario, India being a net crude import country, right? So every large sum of our imports consist of crude oil, and crude oil we import from various countries of the world, and if we are paying in terms of dollars, for the same crude oil, same quantity of the crude oil, will have to pay more rupees because the dollar has become expensive. What it means is that exchange rate fluctuation, right, affects the companies, it affects the stock prices. So exchange rate is also very important indicator for analyzing the fundamental analysis. International credit rating. There are various credit rating agencies like Standard & Poor, Fitch, Moody's. If they downgrade the credit rating of a country, right, certainly in the international market, raising of money will become more expensive. If they upgrade in a rating of a country, because these international agencies rate not only a company but they also rate economy as a whole, the country as a whole. So if the credit rating goes up on the positive direction, it is a good sign for a country, because in that scenario, the companies, the government and the various agencies which want to raise the money, right, they will able to raise. Suppose Indian companies want to raise money in the international market. If Indian companies want to raise money in the international market, if the credit rating agencies rates a company on a higher rating, right, so certainly they will able to raise at a lower rate of interest, because in that scenario, high rating means less risk involved. So when risk is involved, the international funding agencies funds a country or fund the companies of a country or funds a particular industry or a company or specific companies, right, at a lower rate. So what is this international rating of the country as a whole? That also affects the economic environment of the country, right? So international rating agencies like Moody's, Standard & Poor, Fitch releases reports on economic outlook and credit rating of economies of the world. A rating downgrades has an important signal to recess the investment portfolio. If the rating downgrade takes place, it's a negative sign for the stock market, and in that scenario, companies find it difficult to raise money. Policies of the leading nations. When I say the world leading nation means which are major exporters and importers in the world. So policies of leading nations, including the monetary policy, fiscal policy, tax and investment related policies, influences the global economy and investment flows in the Indian security market. Means suppose the Fed means the Central Bank of America. If Central Bank of America increases the interest rate, so it means that the inflow of capital that is taking place in the Indian stock market will be influenced by it, because in that scenario, more and more companies of America, the funding agency, pension funds will be investing in America instead of India. So it will affect negatively. So what are the monetary policy, what are the fiscal policy of different countries, especially the leading nation, that also affects the stock prices. So in this discussion, in this lecture, we have talked about the different fundamental factors which affects. I'll be continuing this in my next lecture too. Thank you.